Hello, my name is Joe Hoyle, and I'm one of the co-authors of your financial accounting textbook. In this particular video, I want to walk through a few basic questions from chapter 3. These are questions that tend to bother or confuse or distract or whatever my students in financial accounting. So I like to make sure before we get too far into chapter 3 that all of my students understand these 6 questions. So what I'm going to do is to give you a couple of questions, and I hope what you will do is to pause the video and come up with your own answer before you watch my answer. You will always learn more if you provide an answer before I provide the answer. Whether you're correct or incorrect, you're coming up with your own answer is the best way to learn this material. So let's get started. Here are the first 3 questions I'm going to address. The first one is, what financial statements do organizations typically prepare and issue? Now, there's always going to be a little bit of a name change here or a name change there, but financial statements are fairly well standard from one company to another. So that's first question. Second question is, what is an account? We talk a lot in this course about accounts. What exactly is an account? That's our second question. And our third question is one that always makes my students think and pause a little bit. A company incurs a cost, in this case, we'll say $10,000. How does the company know whether to report that $10,000 as an asset or as an expense? Because if you get that wrong, your financial statements will be incorrect. And companies incur cost all the time. So this is a question they typically face quite a bit. If you have a cost, is it an asset or is it an expense? So stop the video, answer these 3 questions, and then turn the video back on. Let's go look at them. Our first question was, what financial statements do organizations typically prepare and issue? You can go on the internet and do a Google search, and you can find financial statements for almost any company that you've ever heard of. And they typically will look like this. And notice they're always going to be in this order. So typically, at least in this textbook, they'll be in this order. We always start with an income statement to determine net income. And some companies may call that a statement of earnings, but I like to call it an income statement. There's also going to be a statement of comprehensive income, but that's fairly complicated, and we'll hold off on that until a later chapter. So the first statement's an income statement, and then we go to the statement of retained earnings. And we're going to talk in just a second about what retained earnings means. Many companies actually expand this statement into a statement of stockholders' equity, which includes more accounts. Here early in this textbook, I want to keep things simple to make them easier for you. So we're simply going to have a statement of retained earnings. Third, there's going to be a balance sheet to record the assets and liabilities of the company. And then finally, there's a statement of cash flows. If you have an income statement, a statement of retained earnings, a balance sheet, and a statement of cash flows, you'll be amazed at how much you can learn about any company that you're interested in. If you learn accounting, if you learn how to read these financial statements, they become very helpful in gaining an insight into a company and being able then to predict its financial prospects and future health, which is what you want to do as a decision maker. That's our first question. Question number 2, what is an account? An account is an individual balance, an individual monetary balance that is monitored and reported by a company so that it can be reported on its financial statements. Take your personal life. Let's assume that you're going to keep up with your money. And so what accounts would you have? You spend money for food, so you might have an account for food. You spend money for clothing, so you might have an account for clothing. You spend money for books, you might have an account for books. Every time you want to keep up with an account or keep up with a balance, then you have to have a separate account. So for companies like you and I might look at on the New York Stock Exchange, They will have hundreds of accounts and maybe thousands of accounts. Easy ones for us: cash is an account. Inventory is an account. It's a balance that you want to keep up with. It's a balance of the amount of goods the company is trying to sell. Sales revenue, the amount that they have generated from selling goods or services. That's an account balance that you're monitoring. Salary expense, the expense that you incur by paying your employees. All of those are accounts, and they will then be reported on a set of financial statements so that the information is conveyed to decision makers. You can see how we're building up a process to get the correct or the best information to outside decision makers so they can make wise decisions. Here's a question that my students always are interested in. Company incurs a cost of $10,000. How does that company know whether to report that $10,000 as an asset or to report it as an expense? Well, you always begin by looking at the asset first. Now, remember, an asset is defined as a probable future economic benefit owned or controlled by the reporting entity. Now, that's a formal definition. What I have said before is it's something of value. It's something you own of value. But what is that value? In a business organization, that value is that it helps you generate revenue. That's the future economic benefit. So if you pay $10,000 for equipment, that will help you generate revenue in the future. That is an asset. If you pay $10,000 for a delivery vehicle, that is an asset. It will help you generate revenue in the future. So you always start with the assets first. If it does not qualify as an asset, then you report it as an expense. And the assumption is with an expense that it was going to help you generate revenue, but it has already done all of that in the past. So in my mind, I always view assets as future benefits and expenses as past benefits. But the reality is, if it's a future benefit, if it's going to help you generate revenues in the future, then it's an asset. If it does not help you generate revenues in the future, then it is an expense. So those are our first three questions. How did you do? What we're trying to do, of course, is to help you add knowledge one little bit at a time. So I want to ask three more questions. Again, stop the video if you wish and think about them yourself. A company reports a $12,000 gain or maybe a $9,000 loss. How are gains and losses different than revenues and expenses? We know what revenues and expenses are. Well, what's a gain or loss? Question 2 in this second section. Financial accounting is said to be conservative. You'll hear that term often when you're talking to people about financial accounting. They will say, oh, it's conservative. What does that actually mean? What does that tell you? And how conservative is financial accounting really? The second question. And our third question is an account that a lot of people misunderstand, and that is retained earnings. So let's assume a company has a retained earnings balance of $640,000. What does that balance tell decision makers? What is the information that's being conveyed to those decision makers by that account and by that balance? What is retained earnings? If you wish, stop the video, take a few seconds to think about how you would answer these questions. Ultimately, it's not important that I answer them. It's important that you answer them, or that you be able to answer them. So let's look at them. Company reports a $12,000 gain or a $9,000 loss. How is that different than revenues and expenses? Well, we already know that revenues and expenses are inflows or increases in net assets, and expenses are outflows in net assets. But those things come from the primary business operation. So if you and I were to create a pizza restaurant, then a revenue would be selling pizza. A revenue would be selling a soft drink. A revenue would be selling a salad. An expense might be what you pay your employees, a salary expense. Or an expense might be what you pay for the building, a rent expense, because all of those relate to the primary business of pizza. On the other hand, a gain is an inflow or increase in net assets that is not from the primary business operation. A loss is an outflow or a decrease that's not from the primary business operation. So let's assume, for example, that we have a fire and we lose some money. Well, that is a loss because we're in the pizza business. We're not in the fire business. Let's assume that we have a delivery truck and we sell it for a gain. That is a gain. That's not revenue because we're not in the delivery truck business. We're in the pizza business. So if it's part of the primary business, an increase is a revenue. A decrease is an expense. If we're in the pizza business and something happens that's not part of the primary business, then the result is either a gain or a loss. And the reason we make that distinction is to help decision makers better understand what they're seeing. So they're interested in what part of the increases and decreases come from primary business and what part come from something other than the primary business operation. Question number 2 in the second section. Financial accounting is conservative. What does that mean? Accounting, I believe, has an over reputation for being conservative. I don't think accounting is nearly as conservative as people will sometimes say. If an outcome of an event is truly uncertain, if you really don't know what's going to happen, then the company will report the outcome that will make it look worse. So if you think something's going to happen and you're simply not sure at all, then you pick the outcome that makes the company look worse so that decision makers are not overly optimistic about what's going to happen. You want to avoid getting people too interested or too excited about a company. So if you're truly uncertain about what's going to happen in accounting, you always pick the worst outcome, and that is to protect the decision maker from unnecessary enthusiasm. However, and this is what I tell my students all the time, in business, there is rarely things that are truly uncertain. Most of the time, you have at least a reasonable estimation of what's going to happen. And the goal in financial accounting is to report what happens. So if you can make a reasonable estimation, then there's no reason to be conservative. You use that reasonable estimation in that case. So accounting is conservative, but it's not as conservative, I don't think, as its reputation would say. And then what I call a mystery account, what is retained earnings? Balance is $640,000. What does that balance tell you? Well, I'm going to give you 2 ways to look at this. Retained earnings, and I've got retained earnings spelled wrong there. Retained earnings is the total of all net income less all dividends the company has ever paid. So if you take all of the net income that the company has ever made and subtract out all the dividends that were distributed to the shareholders, that number is retained earnings. Now, often people in my class will say, where is this? Assets and liabilities report what you have now. All other balances report something that happened in the past. So an asset is something you own now. A liability is a debt now. All other balances report something that took place in the past. So retained earnings is not an asset or a liability. It is a description of something that took place in the past. How much net income have you made since you first began, less all dividends paid? A second way I think of this is it is the portion of the company's net assets that came from the operations of that entity. So if our company here had net assets of 900,000, then it would know that 640,000 of those assets or those net assets came from business operations. It came from the net income that has been generated since the company began, less the dividends. Now, that's only 6 questions, but I believe firmly that if you have a good understanding of those 6 questions, that will give you a very good foundational knowledge about financial accounting. And that's what we're trying to build here, a strong understanding. My name is Joe Hoyle. I'm a co-author of the Financial Accounting Textbook. And as always, I'm delighted to have the chance to talk with you. Have a great, wonderful day.